Hello, ladies and gentlemen. Welcome to Triple N Media. I am NIK NIKAM. In this presentation, we're going to look at some of the strategies that you can use during a market crash. Or if you anticipate the market is going to crash, you need to be prepared not during the crash, but before the crash. So I'm going to show you some of the techniques that you can use in anticipation of a market crash. The worst thing you can do is lose your assets and have no money left to trade when the market hits the bottom. When the market hits the bottom, that's when you need to have a whole chunk of cash so you can get into the market. Remember what happened in March 2020 when the market dropped 40%? All those people who had cash, they put it in the stock market and went to sleep, and in 1 year that went up like almost double their money. So that's the secret. So it's not going to happen every time like that, but many experts are predicting that the stock market would be crashing sometime this year, and it may retest the March 2020 lows. So are you ready for that? Okay, don't worry. I'm going to give you some tips so you can use those tips and be prepared to protect your assets. Let us start off with the so-called covered calls. Let's say you have like 500 shares of QQQ, which is the Nasdaq proxy index of 100 stocks. The top 100 Nasdaq stocks are represented by an ETF or exchange traded funds known as QQQ. This is traded just like a stock. That's the advantage of this. Let's say you own 500 shares of stock. If you did, you have seen that in the second, third, and fourth week of February, it dropped 14%. And it is zigzagging right now, and it could drop again, and we don't know. So how do we protect ourselves? So we can write covered calls. For every 100 share, you can write one call. That means you sell the call to open. That's what it's called. You sell 5 calls to open. But here is the secret. If the stock price is at 320, there are various strike prices ranging anywhere from 200 to like 300 or 400. But you want to anticipate how much the stock is going to drop. If you think that the QQQ ETF is going to drop like $10, you don't want to write $320 call because there's not much intrinsic value left in this one. So all you left is a time value, and it's not going to help. So if you are writing a covered call anytime when you anticipate a market is dropping, you need to write a call that is at least like 10 points below the current market price for that ETF. Why am I saying that? Because if your ETF is $320, and if you write a covered call for $310, you have $10 of the ETF price built into this option. So if it drops to 310, you're not going to lose the entire $10. You may lose like $3 or $4, but the remaining part is covered by covered call. So you recover that as a cash. So in this way, you can minimize your loss from 100% to like 30% or so. That is far better than losing a shirt or a pant. Okay, so when you are talking about calls, there are a lot of things we need to be concerned about. We need to be worrying about the strike price, which I talked to you already. We need to worry about the time value. So you can write a covered call for 1 week, 2 weeks, a month, or 3 months. What time frame do you pick? You have to decide, because it depends upon how far you think the market is going to drop or how long this downward trend is going to stay. But you see, you can write for a week and see how things go. But in a week, if it drops 20 points, then you're going to lose money because you are covering only the bottom 10 points from 320 to 310. That means if it drops below 310, you're not going to get much value because it has the so-called intrinsic value. You need to read up on those things. In addition to that, these stock options have very big spread. There's a pretty big spread between buy, ask, and bid. So that's something you have to kind of fight it out and get it. But sometimes you don't have a choice. You just have to get it because the other option is to lose 100% of your value when the market drops. In addition to that, there's a time value. The time value works in your favor if you are writing a call and if somebody else buys your call. So that's one good advantage. The other advantage is, of course, I told you, if the ETF price drops from 320 to 310, you're not going to lose the entire $10. You may lose like $3 or $4 because the other part is covered by the option as a cash coming back to you. So that's so far as the covered call is concerned. Let's take an example here. Let's say this is TQQQ. Let's say you have 500 shares in your account. You don't want to sell it. You want to sit on it. Even if the market crashes 50%, you want to sit on it. If that is your determination, if the TQQQ price is $94 and you buy 5, you sell call options 5, and it's a $5 for each option price. So you get $2,500 because each option covers 100 shares of TQQQ. So you get $2,500. Let's say the next day, the morning, the stock drops to $88.29, a drop of like $5.72. All right. And the option price also drops $3.52. But since you sold the call option, you got money, $2,500. Now this option is worth only $710 because this is the price for the option, $1.42. So the difference was $3.52. So that's the money you get to keep if you clear that account. That means you buy back the option at that time, you get $1,700. But as you can see, your loss was $5.72 from this drop. And this $3.52 is what you recovered. So your actual loss is like $2.20 instead of $5.72. You get it? So that's how you try to minimize your risk during a market crash. That is the story about covered calls. There's a lot of things that we need to learn about covered calls, but this is a very quick overview of the covered calls. There are other options also that are available. Let's look at them. The other one is called buying puts. See, in the previous one, I talked about selling call options as long as you own the stock. But to buy puts, you don't need to own the stock. You can just go and buy a put for QQQ, SPX, or Dow, any one of these ETFs. And when you buy these puts, every time the stock price goes down, the put price goes up. Do you follow? When the stock price goes down, the put price goes up. So you recover some costs from that. But there are some limitations as far as puts are concerned. That is, again, we have the spread between the ask and the bid. That's something you need to kind of fight it out and try to get it. Number 2, I talked about the time decay. There are multiple things built into a put. One is the intrinsic cash value and the time value and also volatility and interest rates. So let's just focus on the time value. Every day you are holding the put, you are losing the money you gave for the time value. And if you look in the the option chart, you will see all these, the delta, how much the option price goes up or down based on $1 price change in the ETF. Then you also have the theta, which is the rate of time decay of the value of your option for the time. So there are a lot of things you need to take into consideration, but you just have to learn these things if you want to protect your assets during a major market crash, which may be coming sometime this year or next year. Just like the call option, you minimize your risk by buying puts and recover some of the cost that you would have lost by a precipitous drop in your stock price or ETF prices. Again, when you are buying these puts, I would check the most frequently traded ones so that there is big volume. As a result, when there is a big volume, the spread between the ask and the bid is going to be smaller, unless if they are trading like 20 or 50 shares 50 options a day, you're going to have a huge difference. So always look at the chart and see which one has the highest volume, and that's where you go. You go where there is a crowd. Here's another interesting thing that I would like to talk to you, and these are called ultra short ETFs. What is ultra short or short or ultra short ETFs? So there are certain ETFs, just like your QQQ or SPY or DIA. There are other exchange traded funds. They trade just like stocks. They have an ask and a bid, but there's no time decay because it is not an option. This is just like a stock. For example, if you own a whole, like say 30% of your money is in S&P related investments. So then you can come back and say, okay, I am expecting maybe a 30% correction or something like that. Then you have these ETFs. There's a whole bunch of those just for S&P. You can get one that is 1-to-1. When this is going down, the price goes up. Like if it's plus, when the stock price is going up, the option price goes up. The ETF price goes up. If the S&P is dropping, and these ETFs go up in the opposite direction. So if you are worried about covering your long positions in the S&P, you may want to look at like 2x or 3x. That means the value goes up 2 times the S&P drop. If the S&P drops 1%, this will go up by 2%. If the S&P drops 1%, here the SPXU ETF will go up by 3%. So that's how you can hedge your like sector specific stocks with these ETFs. The good thing I told you is these are not options. So you don't have to worry about time expiration. You can keep it forever if you want. See, here we have for Nasdaq. I'm not going to go through all these names. You just type these names in the search bar. Then it will display a chart and the price. Then you'll know. So we have one for S&P. We have for Nasdaq. We have for Dow. We have mid-cap 400. There's one for Russell. So you need to remember these things in a crash market, because if you don't want to sell your stocks and you don't have time to sell your stocks because they are kind of tied up in an account, then you can go and buy these ETFs so that you can recover some of your losses. And here are some other things like treasury bills. Let's say you have cash, you want to make some money out of your cash. You can buy these ETFs. See, if you buy a treasury bill, you have to hold it for a year or 2 years or something like that. Or if you buy any other mutual fund, bonds, things like that. But here, these are ETFs. They trade like stocks. So you can look at the treasury bill that matches the 10-year treasury or a 20-year treasury, and then say you want the prices to go up. So usually the treasury goes up during a downward market. So you want to buy something that is like 1 times the equivalent to treasury, or 2 times or 3 times, and see if you can make some extra money there instead of your cash sitting there and collecting dust. And there are also a series of industry related ETFs. They can go up like 2 times up or 2 times down. And for example, if you have a lot of money invested in healthcare, biotechnology, or oil and gas, real estate, you can just go and hedge your losses by using these exchange traded funds or ETFs. So those are some of the ways in which you can protect your assets. If nothing else works, if you can get all your money out of your stocks and bonds and all these things, just put it in the account and wait. Wait for the hurricane to go. Wait for the winds to settle down. Wait for the dust to hit the ground. When things are quiet and the market is turning around, then you slowly get into the market. Make sure that you don't put all your eggs in one basket. Of course, you diversify so that, again, we go back to this. You see, we can always use these ETFs. This is the best way to put your money in the market. You don't need an expert to tell you what to do, because you diversify. Some of it in SPY, which is a ETF, or like QQQ, which is a Nasdaq composite index of 100 stocks, or diamonds, or they represent the Dow 30 stocks. So you can go and buy some of these slowly and see how things are making. If things are making progress, then you can invest some more and leave some money for cash for a rainy day. Because if another hurricane hits, you never know. They always talk about in the stock market about the second shoe dropping. Just when things seem like they are all settled and everybody is trying to get into the market, and all of a sudden you see again the market drops. That's called the second shoe drop. And that is very commonly seen. When both shoes drop, that's when the market slowly recovers and try to go for the Mount Everest. Well, that's a Cinderella story, but it doesn't happen all the time. So these are some of the techniques that you can use as far as protecting your assets, reducing your losses, and perhaps maybe make some extra cash or save your money as a cash for the worst scenario. Thank you so much for watching this presentation, and please do subscribe to our channel. I hope your $1 million stays safe, and please do subscribe to our channel, and I will see you next time.